Hi, it's Ted Whitehead of Arrow Capital. I'm the lead portfolio manager of the Exemplar Growth and Income Fund, and today is June 19th. I'd like to do a presentation today to give an update as to what's been going on in the fund and where we see things going forward. We'll do a summary, the process, outlook, and conclusion. In summary, the fund is up a little over 8% as of today, and on the 1-year basis, and on the year-to-date, it's up around 4.4%. The fund has won 6 Grade A Plus awards for the years 2017 through 2022, and this is for the best risk-adjusted return funds. The fund's process is a diversifier versus other balanced funds. We use a macro top-down process. The fund pays a dividend of 4%, and the yield is internally funded from holdings. And lastly, the fund is outperforming the index and peers since inception, March 15, 2015. Here's a slide demonstrating our performance. We are the blue line. The red is the index, and last, the yellow is the peer group. So our investment process is a top-down macro. What we're trying to do is forecast or predict where 2 factors are going, one being growth and the other inflation. And the reason for doing this is the outcome is to try to forecast what will happen to interest rates. And as you know, the importance of interest rates is they are used to as a discounting mechanism for future earnings on companies, and also interest rates determine borrowing costs. So using the quad model, quad 1 and 2 are both accelerating growth, and quad 3 and 4 are decelerating growth. Quads 1 and 2 are disinflation, and quads 2 and 3 are inflationary. Our forecast for the real GDP in the back half of the year is for things to trail off, and we use Hedgeye and their estimates. The consensus, or Wall Street, has the same thing, so we're in line with the consensus for growth to slow down. It's not predicting a recession, but just a slowdown in growth. And things that go into forecasting real GDP are leading economic indicators, job growth. Well, the Atlanta Fed forecast has a model on growth, and that's another thing we keep an eye on. And for the second quarter, they have it accelerating to a little over 3%. For inflation, here is where Hedgeye and the street, or Wall Street, the consensus, diverge. As we know, what is happening is services such as healthcare, insurance, and rents are more sticky and are coming down more slowly, and if not accelerating, whereas goods such as TVs, cars, etc., are on the way down because inventories have been increasing. So to move product, prices have to come down. So this is a bit of a discrepancy, and who knows, maybe it comes down right in the middle where it doesn't go really up or down, but we'll be mindful of this. So, but based on Hedgeye, it's looking more like a quad 3 than what would be a quad 4. So the importance of identifying these quads is also what happens, as we said, to interest rates. And quad 2 are where interest rates are going up, and quad 4 tends to be when interest rates are going down. And in quads 1 and 2 is really where PE multiples are most affected. So last year we were looking at a recession developing in the first half of last year, and the probability of that quad 4 seemed relatively high in our eyes. So we were positioned for that. Unfortunately for us, that didn't really pan out. What happened is government spending was at rates that were consistent with depression or World War. And so that kept the economy from slipping into recession. Also, when we had the banking crisis at the end of March, the Fed loosened financial conditions, and that also helped alleviate pressure and avoided a quad 4 scenario. So it turned out that last year was all quad 1, so that's growth with declining inflation. The go forward, as I mentioned, we're coming through a quad 2 right now, and it looks like the back half of the year will be quad 3s. But as we noticed in the discrepancy between Hedgeye and the street, is it possible that could turn into a quad 4, and we'll be cognizant of that on the go forward. On the next slide here, it shows how active we really are, and we change between bonds and equities and commodities and cash a fair bit. And we were quite low on equities in the second quarter of last year, but since then have bounced back on the equities, and our performance has improved with that. We didn't do it right away. As you know, this last summer, the market kind of went sideways to down, and so we started increasing our equity weighting more dramatically around the middle of October. So our current positioning is, as I said, more for quad 3, but we are cognizant that forecasts are forecasts and don't always come to fruition. But if it is a quad 3, one of the best sectors to be in is energy. And that's our biggest weight at the moment. As you'll recall, the first half of 2022, energy was the best performer, and those were back-to-back quad 3s. On the fixed income front, we've been increasing our allocation there and increasing our duration. We have 25% that are 10 years or longer, and our expectation is that yields will finally succumb, and whether the Fed likes it or not, the market is telling you that. The 10-year yield is now into the low 420s, and I think there's further room for it to go. On the geographical split, we tend to have more US bonds, and that's because the yields are higher there, and we have more Canadian equity than US equity. In the current environment, or the environment we're looking at of a quad 3, that should benefit the Canadian market on the go forward. In commodities, we have our biggest weighting is towards gold, but we do also hold silver and Bitcoin. Our weighting in the US dollar is around 30%. If it does prove to be more of a quad 4, then we will raise that US dollar to a higher level. But 25 to 30% is really a neutral weighting for US dollars for us. And in quad 3, you should be more or less neutral US dollars. So the new landscape that has transpired since COVID are 1, high government debt levels, 2, 24-hour options, 3, commodity trading advisors, 4, vol control funds, and lastly, passive has outgrown active assets in the last 18 months. So when people say to you it's similar to 1995 or 2007, I think these are 5 things that would say that it's never the same. Point 6, you could say, is the migration that's been going on globally. So the government debt levels, I guess it's not a problem until it's a problem. On the 24-hour options, it's making individual stocks more volatile. On the CTAs, these are funds that tend to, well, what they do is they buy more as the market goes up and they sell more as the market goes down. In vol control funds, they sell volatility or the VIX and buy the underlying equity. And passive over active, I think, has removed the importance of fundamental analysis in the marketplace, which will return at some point. At this time, I'd like to introduce Ashley Kennedy. He's been working with Chung Kim for over a year now at Arrow Capital, and he will be joining the team immediately to give assistance with running the fund. So I'd like everyone to give Ashley a warm welcome, and hopefully in the near future, you'll get an opportunity to meet him. So why invest in the Exemplar Growth and Income Fund? One, I think it's a one fund solution that gives active asset allocation between stocks, bonds, currencies, commodities, and cash. We offer a lower correlation between our benchmark and peers. We've had a history of successfully navigating difficult markets, and we have been able to minimize drawdowns in those markets. It's an ideal fund for someone looking for professional asset allocation. The fund is dynamic, and we try to generate returns in every stage of the economic cycle. The fund is available in both mutual fund form or ETF. So on that, I'd like to thank everyone for listening, and we will hope to see you soon, and have a nice summer. Thanks. Bye.